Hello, everybody. It's Harry Swaminathan from OptionTiger.com. Welcome to the free course library. And in this free course, we're going to look at technical indicators called oscillators. So, oscillators are cycling indicators, meaning they go on an up and down cycle based upon the stock's price action. So, you generally will see that when a stock may be overbought or in oversold conditions. Now, the important thing to remember is that these can remain in these conditions for a long time. So we'll take a look at two of the most popular oscillators in this free course. They are the RSI and the percent R, and there's a slight difference between the two. So in some cases, it may be advantageous to use the RSI, and in some cases percent R. So we'll study both of these, but always bear in mind all technical patterns are always trumped by fundamentals. So meaning it doesn't matter if something is totally overbought or oversold. Any fundamental events, geopolitical factors, something pertaining to the stock, lawsuits, oil spills, these kind of fundamental events will always trump any technical pattern. So it might be at a completely overbought area, however, it can continue to go higher, or it might be completely oversold and it will still get sold further if there is fundamental news. And this goes for all technical indicators. Technical analysis itself will work when there is little or no fundamental events that can move the markets or move the stocks. So let's go into the Thinkorswim platform and let's look at the RSI and the percent R. So here we are looking at Netflix. This is a 3-month daily chart. Actually, let me just go back a little bit more. Let's do a 6-month daily chart. And what I have here are three of the indicators. One is volume, one is RSI, and then the percent R. Now, the volume we don't have to worry about. Let me shrink that. Okay, first let's look at the RSI. So here on the Thinkorswim platform, if you edit your studies, you can see that the RSI is, these are the parameters. So you have the RSI itself, which goes back, the default values are, it goes back 14 days to calculate the index. The overbought condition is 70, the oversold condition is 30. Now, if you wanted a little bit more stringent, you can change these numbers to 80 and 20 or 90 and 10, whatever the case might be. But basically, you're telling yourself when you want to be alerted as to when a stock may be oversold or may be overbought. So let's go take a look at the charts itself and look at the RSI first. So here, as you can see, the RSI has gone into overbought area. So right here, it's gone into overbought. But you can see that the RSI, it remains in overbought for a while. However, the stock seems to have gone up a little bit further, and that's the case. So this is not a timing indicator. It just gives you an indication. You probably are looking for other indicators as well to tell you whether you need to you need to take a change in the trade or either buy or sell. But it gives you a overall indicator that it's getting into overbought. So at some point it's going to turn around, and sure enough, it takes a few days, but it does turn around. And then, as you can see, it goes into oversold very early here, and it remains in oversold for some time, and then it tries to get out. So here, if you look at it, the midpoint is obviously the 50 value. So here the oversold is the 30 and the overbought is the 70. Now you'll see that while it's in this middle areas, really the stock won't probably is not doing much at all. It's not trending at any time. So you can choose your trades based upon this. So if you saw this kind of a price action for a few days, perhaps things like credit spreads and iron condors would be good, because it's not showing any kind of a trend. And if you were to put a 2-week trade on an iron condor or a credit spread, it might work. Whereas once it starts trending and you can see it goes into overbought areas, perhaps just a straight long call, or if it's coming down, you can just buy a long put. So that's how you would use the RSI. The the percent R is also similar. It looks back 14 days and it's got a slightly different default setting. It's got 20 and 80. The percent R is a little different from the RSI, and so it actually may be a little bit more helpful in the sense that when the percent R goes to oversold, it doesn't really mean that it's telling you that the stock is going to turn around. In fact, it's telling you the opposite. It tells you that the stock has entered a bearish mode. So, really, if you look at the difference between the RSI and the percent R, the percent R gives you a signal much earlier that it's oversold, but you can't read it as oversold. In fact, you have to read it as a bearish trend. So that's the big difference between these two indicators. In that sense, the percent R is more of a trigger indicator. So, if you see the percent R going into oversold quickly, and that's somewhere here, and it's telling you actually that it's entering a bearish mode, and so you can actually take a bearish trade, and sure enough, you can see that if you had followed the percent R, you would have done well. Similarly, if you look on the other side, the percent R gives you somewhat of an early indication that it's entering into a bullish phase. So rather than looking at percent R as overbought and oversold, perhaps it's a better way to look at it would be to tell you what is the current sentiment of the stock. Obviously, if it's in the middle, then there is then there's nothing there. As you can see, again, just like the RSI, the percent R is right, it's in no man's land right here in the middle. However, in both of these, in Netflix in the past 6 months, you can see there have been two big cycles. One was this big bearish cycle, and the other one was this big bullish cycle. And the percent R actually gives you a pretty accurate. I mean, it's not going to give it to you exactly at the top or the bottom, and no indicator can do that. However, the percent R gives you a fairly good early indication of the current sentiment of the stock. So when it enters this oversold area, you're really looking at it as a bearish signal at that point. Whereas when you look at RSI, you're looking at it as a reversal signal. Whereas in the percent R, it could be a trigger because it gives you an earlier indication that the stock is entering into a bearish mode, and all the way till here it does a pretty good job. Similarly, from here it picks up, if you look at it right there, it picks up the bullish signal and it goes all the way till, let's say, till here. So the big difference between the two and the percent R, if it remains in overbought, it's telling you the stock is actually in a bullish sentiment, whereas the RSI, typically you look at it as a reversal signal. So these are the two oscillators. There are many more oscillators. The technical analysis and studies are extensive. However, you want to keep things simple in your trading. So whenever you whether you pick a price indicator or a momentum indicator or an oscillator indicator, you want to pick one or two. If you understand how the indicators work, then you can perhaps pick the one that's best suited to your trading style. So in the case of oscillators, these are the two popular oscillators, the RSI and the percent R, and they both work a little differently. And sometimes you can use the RSI to see when a reversal point might come, and many times you can use the percent R to see when a particular sentiment sets in. Thank you for watching this video. If you have any questions, please email us at info@optiontiger.com. Thanks.